Imagine a time when everything seemed perfect. The economy was booming, everyone was getting rich, and life felt unstoppable. But in 2008, that perfect world came crashing down. The US financial system was seconds away from total collapse. Banks you thought were invincible were falling like dominoes. What really happened behind closed doors? Too Big to Fail reveals the gripping story of the powerful few who had to make impossible choices as the world held its breath. In the early 2000s, the United States was riding high on a wave of economic prosperity. The stock market was booming, housing prices were soaring, and it seemed like everyone was getting rich. But that happiness didn't last long. By September 2008, the US financial system was on the brink of disaster. Wall Street giants that once seemed untouchable were crumbling. The very foundations of the global economy were shaking. We all know about the crash of 2008, but Too Big to Fail gives us a rare look at the beginning, middle, and end of this catastrophic mortgage crisis, caused by a mountain of risky loans and toxic assets. Based on the bestseller by Andrew Ross Sorkin, the film puts you in the room with Henry Paulson, the US Treasury Secretary and former Wall Street insider, at the center of the storm. The film dives into the critical decisions and the intense political environment that surrounded them, showing that if a system as massive as the US economy could collapse, any system could. This is the story of how the American dream turned into a nightmare. This is Too Big to Fail. The movie opens with the optimism of the early 2000s, where owning a home was not just a goal, but a cornerstone of the American dream. In a speech, President George Bush emphasizes the government's commitment to making homeownership a reality for thousands of US citizens. "This project," he declares, "isn't just good for the soul of the country, it's good for the pocketbook of the country as well." As a result, the housing market surged to unprecedented heights, with both the Dow and the S&P breaking records. Everyone, from first-time buyers to seasoned investors, was caught up in the frenzy of building, buying, and selling homes. It seemed like the American dream was within reach for all. But as stockbrokers and bankers anticipated making fortunes, some even hoping to earn $50 million, they thought they were winning. Who could have predicted that this would lead to one of the worst economic crises in human history? The real estate bubble was real, and the new story was the mortgage meltdown. The numbers told the tale. A record number of Americans were losing their homes. Over 70 mortgage companies went bankrupt, sending shockwaves through the economy. The alarm bells were ringing. Bear Stearns, one of the largest investment banks in the country, was teetering on the edge of collapse due to its heavy exposure to mortgage-backed securities, complex financial instruments tied to the booming US housing market. As housing prices began to fall and foreclosures surged, these once valuable assets turned toxic. Mortgage-backed securities, or MBS, were created by bundling thousands of individual mortgages together and selling them as investments. The idea was to spread risk, but it also obscured the true quality of the underlying loans. The Federal Reserve, fearing that Bear Stearns' failure could trigger a broader financial panic, orchestrated an emergency sale to JP Morgan Chase. In a shocking turn, Bear Stearns shares were sold for just $2 each. This unprecedented move seemed to calm the markets, at least for the moment. The message appeared clear. The government would not allow a major financial institution to fail. But the relief was short-lived. By September, another investment banking giant was in trouble. Lehman Brothers. Like Bear Stearns, Lehman was heavily exposed to the collapsing mortgage market. But unlike Bear Stearns, Lehman was so much larger. The fourth largest investment bank in the US, it had $639 billion in assets, but also $613 billion in debt. As the value of its mortgage-related assets plummeted, the bank's very existence was threatened, and investors lost confidence. Lehman CEO Dick Fuld was desperately searching for a lifeline. He reaches out to potential buyers, including Bank of America and Barclays. But without government backing, no one wanted to touch Lehman's toxic assets. Now, this is where things get tricky. You see, they were flirting with the idea of moral hazard. Moral hazard is a key concept in economics. If banks believe they'll always be rescued, they have no incentive to manage risk properly. It's like giving someone fire insurance and matches. They might become careless. The fear was that rescuing Lehman Brothers after already stepping in to save Bear Stearns, would send a dangerous message to Wall Street, that no matter how reckless their decisions, the government would always step in to save them. This could encourage even riskier behavior in the future, leading to potentially even greater crises. But on the other hand, allowing Lehman to fail could trigger a catastrophic chain reaction with unpredictable consequences for the global economy. It was a decision that could tip the balance between chaos and order, and the stakes couldn't have been higher. At the center of this crisis was Hank Paulson. He didn't expect this when President Bush chose him as Treasury Secretary. A former CEO of Goldman Sachs, Paulson understood the complexities of Wall Street better than most. He was determined to find a private sector solution to Lehman's crisis without putting taxpayer money on the line. Lehman was in desperate need of capital to stabilize the situation, so they reached out to the world's richest investor, Warren Buffett, to buy the bank's shares as his name was enough to push the price up overnight. But Buffett wasn't very interested in getting involved with the banks. Eventually, he made an offer, asking for a 40% stake and a 9% return. However, the president of Lehman Brothers refused to work with Buffett, saying he didn't want to lose $360 million a year just for that deal. He believed that the real estate market would improve, the crisis would pass, and they would be fine. Paulson argued that Lehman Brothers desperately needed capital and should not have turned down Buffett's offer, especially since the situation was getting worse. Meanwhile, the president of Lehman Brothers held a meeting with investors who warned him to stabilize the stock price or risk having their brokers and clients pull out and leave the bank. But what exactly are these toxic assets that have Lehman and other banks on the ropes? To understand, we need to dive into the murky world of mortgage-backed securities. In the years leading up to the crisis, banks had been bundling thousands of individual mortgages together and selling them as securities to investors. These mortgage-backed securities were supposed to be safe, diversified investments. The theory was that even if some homeowners defaulted, the overall returns would remain stable. But there was a fatal flaw in this system. Many of these mortgages were subprime loans given to borrowers with poor credit. When housing prices started to fall, defaults skyrocketed. Suddenly, those safe securities were worth a fraction of their face value. Banks like Lehman had borrowed heavily to invest in these securities. Now, they were facing massive losses and struggling to meet their own debt obligations. It was a house of cards ready to collapse. The news showed that the market was putting pressure on Lehman Brothers, with shares of major mortgage companies, Fannie Mae and Freddie Mac, dropping sharply. Barack Obama was on the news, warning that if Lehman Brothers fails, it would be a huge disaster. Freddie Mac had already fallen by 18%. Lehman Brothers still believed, somewhat naively, that the market would fix itself without needing further intervention. Back at the New York Federal Reserve, Paulson's plan to find a private company to save Lehman was falling apart. Bank of America, which was expected to step in and help, decided to buy Merrill Lynch instead, another bank that was also in trouble. With time running out, Paulson turned to Barclays, a British bank. But at the last minute, the UK government said they wouldn't approve the deal unless the US government gave guarantees, which Paulson refused to do. Meanwhile, Chris Flowers, CEO of JC Flowers & Company, called Paulson. His company's data showed that AIG, the insurance giant, was running out of money, but everyone was too focused on the Lehman crisis. The US Treasury, under Paulson, and the Federal Reserve decided not to provide money to save Lehman or other banks, believing the banks could solve their own problems without taxpayer money. Remember the moral hazard we talked about earlier? Now, it was becoming a harsh reality. By September 11th, 4 investment banks had already gone bankrupt, with losses totaling $30 billion, leaving Wall Street in shambles and assets available at rock-bottom prices. No one wanted to buy Lehman. Its shares dropped to less than $4 each. They had $30 million in toxic assets and $70 billion in wasted funds, still clinging to the hope that they could somehow fix the problem and save the company. 4 days later, on September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in US history and severely damaged the global financial system. The Dow Jones Industrial Average plunged 504 points in a single day. Credit markets froze as banks, unsure who might fail next, stopped lending to each other. People began to fear the collapse of more banks, and many considered pulling their money out, which could have caused even more chaos across the country. The entire financial system was grinding to a halt. You see, credit is the foundation of a strong economy. The Great Depression of the 1930s was bad, but what really hurt the economy was the disruption of credit. In other words, people and businesses couldn't borrow money. This meant that regular citizens couldn't buy houses, start new businesses, or even stock products in their stores. Credit, borrowing money, is crucial to building a strong economy because it helps people and businesses grow. But when credit suddenly dries up, it can destroy the economy very quickly. Treasury Secretary Hank Paulson tried to show that he had done everything he could to save Lehman. The truth was that letting Lehman Brothers go bankrupt turned out to be a bad decision because it affected all banks, companies, and insurers. It wasn't just a major problem for the US. The impact spread to other countries as well. So when they realized they had underestimated the fallout from Lehman's collapse, they were forced to shift gears, abandoning their hands-off approach for more aggressive intervention. Their next challenge came almost immediately. Insurance giant AIG was on the brink of failure, threatening to bring down countless other financial institutions with it. AIG wasn't a bank. It was an insurance company, one of the largest in the world. However, in emergencies, the Fed could lend money to companies that weren't banks. The Fed was considering taking over 80% of AIG because it had valuable assets that could be used as collateral for the loan. Lehman Brothers, on the other hand, didn't have enough valuable assets, so the Fed couldn't justify giving them money. It would have been like lending into a hole, essentially giving money with little chance of getting it back. Even though AIG had assets, helping them still looked like another bailout, rescuing a failing company with taxpayer money, which would make people in Congress and the general public very upset. They were already fed up with bailouts after what had happened with other companies. AIG was deeply connected to the economy. It was involved in construction projects, issued millions of life insurance policies, and managed billions of dollars for teacher pensions. In short, AIG was everywhere in the economy. It all began when Wall Street started bundling home loans into something called mortgage-backed securities, MBS. These bundles were then sold in pieces to investors, and Wall Street made a lot of money doing this. Once they made money, Wall Street wanted more loans to bundle. Since most people with good credit already had loans, they pressured lenders to start giving loans to people with worse credit. So, the lenders lowered their standards. Before, to get a loan, you needed a decent credit score and a down payment. But now, they were giving loans to people with credit scores as low as 500, with no money down. The average person assumed that if a bank was willing to give them a loan, they could afford it. So, they bought houses, trusting that the experts knew what they were doing. The banks knew these risky loans were dangerous, but they kept making them because they were profitable. To protect themselves, banks bought a kind of insurance called a credit default swap. This meant that if homeowners defaulted, couldn't pay their loans, the insurance company would cover the losses. This allowed the banks to keep making more loans and money without worrying about the risk. One insurance company, AIG, took on a massive amount of this risk by insuring all these bad mortgages. They did this because they believed housing prices would keep going up, and they were making huge fees from it. When housing prices fell, homeowners who bought their dream houses couldn't afford the higher payments once their low temporary rates expired. Many defaulted on their loans. When people stopped paying their mortgages, the mortgage-backed securities became worthless. AIG now had to pay out insurance on all these bad loans, but they couldn't afford it. In that case, AIG would go bankrupt. Since AIG couldn't pay the banks, those banks were at risk of losing billions in a single day. As a result, many could go bankrupt, putting the entire financial system at risk of collapse. If you wonder why this wasn't regulated, the answer is simple. Nobody wanted to stop it, because everyone was making too much money. AIG had sold billions of dollars in credit default swaps, essentially insurance policies on mortgage-backed securities and other risky investments. These were meant to reduce risk in the financial system, but instead, they concentrated it on companies like AIG. It's like if one company sold fire insurance to an entire city. If the city burns, the insurer goes bankrupt. So, when those investment bonds started to fail, AIG was on the hook for massive payouts it couldn't afford. The potential ripple effects of an AIG collapse were staggering. Hundreds of banks and other companies around the world relied on AIG's insurance. Unlike Lehman, AIG's tentacles reached into every corner of the financial system. If it went under, it could trigger a global financial meltdown. What too big to fail really means is that AIG was so big and interconnected that if it collapsed, it could affect many parts of the economy. This time, Paulson and the Federal Reserve decided they couldn't let another major firm fail. They extended an $85 billion emergency loan to AIG, effectively nationalizing the company. It was an extraordinary step, but one they deemed necessary to prevent further chaos. The AIG bailout bought some time, but it became clear that piecemeal solutions wouldn't be enough. Paulson and Federal Reserve Chairman Ben Bernanke began working on a more comprehensive plan to address the crisis. Officially called the Troubled Asset Relief Program, TARP, the proposal was bold: a $700 billion government program to purchase toxic assets from struggling banks. The goal was to remove these risky investments from banks' balance sheets, allowing them to lend again and restore the flow of credit in the economy. However, to implement this plan, they needed approval from Congress. Convincing lawmakers to support a massive taxpayer-funded bailout for Wall Street was no easy task. Why should taxpayers pay for Wall Street's mistakes? What followed was a crisis of confidence. Banks didn't trust each other, investors didn't trust banks, and no one knew which institution might fail next. This fear created a self-fulfilling prophecy of failure. Paulson and Bernanke headed to Capitol Hill to make their case. In tense, closed-door meetings, they painted a dire picture of what could happen if Congress didn't act. Bernanke, a former academic economist and expert on the Great Depression, was particularly blunt. Despite the warnings, the initial TARP vote in the House of Representatives failed. The stock market plunged in response. The market's reaction to the failed vote showed just how desperately intervention was needed. The Dow Jones fell 778 points in a single day, the largest one-day point drop in history at that time. Paulson and his team worked frantically to revise the proposal and win support. Finally, on October 3, 2008, a modified version of TARP passed. But even with $700 billion at their disposal, Paulson and his team soon realized that purchasing toxic assets would take too long to address the immediate crisis. They needed to act faster. The decision to directly inject capital into banks marked a significant shift in strategy. It was essentially a partial nationalization of the banking system, something that would have been unthinkable just weeks earlier. Why did they do this? Because direct capital injections were faster and more straightforward than buying toxic assets. By taking ownership stakes in banks, the government could quickly strengthen their balance sheets and restore confidence. On October 13th, Paulson summoned the CEOs of the 9 largest US banks to a meeting at the Treasury Department. His message was clear: they would accept government capital, whether they wanted it or not. $125 billion was injected into the institutions for the good of the country. The capital injections were a form of partial nationalization, but they were designed to be temporary. The government received preferred shares and warrants in exchange for the capital, with the expectation that these would be repaid once the crisis passed. As 2008 draws to a close, the immediate financial panic begins to subside. But the broader economic damage was severe. Unemployment soars, the housing market continues to struggle, and the US enters its deepest recession since the Great Depression. The 2008 financial crisis revealed deep flaws in the financial system: excessive risk-taking, lack of regulation, and the dangers of institutions becoming too big to fail. Complex financial instruments like collateralized debt obligations, CDOs, and credit default swaps hid risks and interconnected the system in ways few understood. CDOs bundled risky subprime mortgages, repackaged as supposedly safe investments, and when the housing market crashed, many became worthless overnight. Meanwhile, unregulated credit default swaps, sold by companies like AIG, promised more protection than they could cover. The government bailouts prevented economic collapse, but many questioned why banks were saved while homeowners were left struggling. In response, new regulations like the Dodd-Frank Act introduced stricter rules for banks and created the Consumer Financial Protection Bureau to protect ordinary Americans. Stress tests were also implemented to ensure banks could survive future crises. Too Big to Fail shows how financial stability is more than just numbers. It's about trust and confidence in a delicate economic system. The big question remains, have we learned our lesson, or is another bubble on the horizon? Money never sleeps on Wall Street, and neither does on our channel. Watch all the mind-blowing Wall Street stories and explore intriguing money movies, all here in one place. Like this video and subscribe to The Money Game to level up your financial game today.